everyone, this is Dr. T Vara Lakshmi discussing you about the break-even analysis and determinants of the break-even analysis as a part of this business economics and financial analysis. Break-even analysis. If a producer is going to be manufacturing a product based on the demand which he has estimated in the outside the market, then after producing of that product, he need to take care of the costing elements. That is, the expenditure that is incurring on a particular product, he has to identify. Once it has identified, then the next step is fixing the price to that particular product. While fixing the product, he has to see the returns must be equivalent to the expenditure which is incurred by the producer. Then that means the income which is coming to the business organization at least should satisfy the expenditure which is incurred by the producer. That analysis is named as break-even analysis. That shows how many units of a producer has to sell to get back the amount which he is invested in producing of a particular product. For example, to produce a particular mobile phone, for the manufacturing, administration, or all the elements, he has spent 10,000 rupees of the amount, and each mobile phone price worth is 1,000 rupees. Then, for at least he has to sell 10 number of the mobile phones to get back his investment of 10,000 rupees. Then that analysis of how many units which he has to sell, or at least he has to get a revenue of 10,000 means the amount which he has to get in the form of the sales to get back the investment in that particular business is called as the break-even analysis. So that's why break-even analysis it is called as a point of measuring the margin of safety for the producer, and it is also used to analyze the stock options, corporate business investment decisions, as well as the sales targets fixing by the producer. That is the very important activity of this break-even analysis in before going to be setting the targets for the sales of a particular product, or before going to incurring the expenditures for any product. That is the break-even analysis. Here, the expenditure which is incurring by the customer or the producers is going to be dividing into two elements. One is the variable cost, another one is the fixed cost. Whatever the kind of the cost he is spending on the products, that may be a direct labor, direct material cost, direct unit cost, machinery cost, opportunity cost, marginal cost, sunk cost, various kinds of the cost might be there, but only the element is the amount which is investing on the product is categorized into two elements, that is segregating into two elements. One is the variable cost and the next one is the fixed cost. So because the cost, for the easy identification of the expenditure on a product, the cost is summing to the either fixed cost or variable cost. So that means all the other costs which are including or categorizing into two elements, one is a fixed one, another is a variable one, and it is depends on the number of units selling by the organization and revenue generating by the organization for a particular product. That is called as the break-even analysis. If we see or observe the break-even analysis calculation, the for every expenditure of the product is categorized into two elements. One is the fixed cost and the one is the variable cost. Fixed cost means the cost that is changing as per the time period but not based on the output of the product, which means which is fixed up to certain time period, then that expenditure is called as the fixed cost. Let us say if a unit of the producer is producing 2,000 units, 4,000 units, 6,000 units, 8,000 units, 10,000, 20, for all that one, up to a maximum capacity of 18,000 number of units production, a producer is spending 10,000 number of rent rent as well as other fixed expenditures, then it will become a linear or parallel line to the x-axis if we take the number of units on the x-axis. And variable cost, which varies as per the output of the production, then that cost will be called as variable cost. For example, assume that a person is spending $20,000 for the producing of 2,000 number of units and $40,000 of the amount for the producing of 4,000 number of units and 60,000 for 6,000 number of units. Which means if the output of the production is increasing, then the amount which is spending on the products is also increasing. Once if we see a linear line, we can observe for the variable cost which is incurring on that particular product. This meeting of the variable cost as well as this fixed cost will be combinedly called as the total cost. So total cost is equals to variable cost plus fixed cost. That meeting of and the production, after the production have fixed a price and they are selling that units, and they'll see the revenue generating of that one. So if the revenue generating with that particular product for the 2,000 units, again they are getting this 20,000s and 4,000s, 40,000s, the same revenue which they are all incurring, then that will be again plots with this help of this revenue line. This meeting of this revenue line as well as the total cost of the product line will be called as the break-even point, which means the total cost which is spending on the product is 1,20,000 as well as the revenue generating that particular products is also equivalent to the 1,20,000. That will be called as the revenue or break-even point. If we observe, the variable cost and the revenue is also same in the same line it is plotted, because the variable cost will also changes as per the number of units which is produced, and revenue will also changes as per the number of units which has sold. So that difference if we have understood, then it is very easy for the understanding of the break-even analysis, because revenue is nothing but the income which is generating by the selling of a product, and cost is the expenditure on that product as well as the remaining benefits which is gained by the organization is called as the profit. So here the cost will be either variable cost or fixed cost. Here the fixed cost is based on the number of units which are producing by the person and the expenditure incurring on that product. Income is the number of products selling by the producer and the revenue which is generating out of the sales of that product. So that's why variable cost and the revenue curve both are all remains almost all equivalent or the parallel to the x-axis because of their proportionate to the number of units which they have sold and the number of units which they have produced. So that's why that meeting point of this the meeting point of the cost and income will gives the break-even point, means we can say that the profit levels are all zero, which means there is no profit as well as no gain for the organization. That point of meeting is called as the break-even analysis. Like this, they can calculate the break-even point for any level of the productions by the producer. In the calculation of the break-even point, certain components has to taken care by the producer, like cost. Cost means he need to take care of the fixed cost as well as this variable cost, and revenue which is generating as well as contribution margin. So mainly the three elements has to concentrate by the producer for the calculation of this break-even point. So costs are categorized into, as per the assumptions of the break-even analysis, are two costs are involved for the every business organization. The other costs are all there, but they are all again subcategorizing under fixed and variable cost. So fixed cost remains constant for certain level of the productional elements, as well as the variable cost is changes as per the number of units. Per unit basis it will be changes. So let us say to produce a product, a machinery is installed worth of 1 lakh rupees. Then that maximum capacity of that machinery is 100 number of the products, means 1 lakh of the machinery cost will be fixed up to 100 number of units. That is called as the fixed cost. And for each production of the product, 1 kilo of the product material is using, which means for 100 number of products, 100 kilos of the material has to use. 1 kilo of the material is equals to 1000 rupees, means they have to spend 10,000 rupees for the production of 100 units. That is the variable cost. The combination of the machinery cost as well as this material cost combinedly will be called as the total cost of the production of the product. Along with that one, there is a room required for this one. For that room, they may pay the rent. That rent will also include as the fixed cost. Then afterwards, they have to sell that particular product. They will pay the wages and salaries. Salaries are all fixed for this month, but the wages are all based on the number of hours worked by the labor. That here the wages will be called as the variable cost, and the salaries paying to the employees will be called as the fixed cost. Like this, every expenditure levels of the business activity will be terms into two elements, either the fixed cost or the variable cost. And the costing to the profit relation here we have to understand is revenue generating by the organization should be equals to the cost, such that the profit will be zero. That element has to concentrate by the producer, because that level of the point is called as the break-even point. Then, once he has understood what's the meaning of the cost, then we have to understand what is the revenue again. Revenue is the income generating for the products which they are all selling. And here in the break-even analysis, again it is assumes that the number of producing products, the same quantity level of the products they are all selling in the market. Let us say with the 1 lakh worth of the machinery and each 10,000 worth of the material has produced 100 number of the products, and this 100 number of the products, each unit is selling with 1000 rupees. Then it will leads to the 10 lakhs rupees of the returns for the organization. That 10 lakhs rupees of the amount will be called as the revenue for the organization. So that's the revenue for the organization. That is income which is gaining by the organization after selling of the products is called as the revenue. And in the break-even analysis, always the revenue is equals to the cost. Then contribution margin. This is a very important concept we need to understand is the contribution of one unit on total income gaining by the organization is called as the contribution margin. So which means, let us say one unit is there, one unit cost is 10 rupees and each unit selling price is, so the price that unit cost, that is the raw material cost or the productional cost. So variable cost for that particular unit is 10 rupees and selling price for that product is 15 rupees. 15 rupees. So each unit's contribution is 5 rupees for the organization. The contribution from each unit is 5 rupees. Then if the organization is spending 100 rupees of the fixed cost, that is common for all the number of units, then we can say that 5 rupees is the contribution margin and the total fixed cost is 100 rupees, means so 20 number of units if the organization is able to produce, 20 number of units if the organization is able to produce or the sale, then they'll get no loss, no gain point. which means a particular unit's contribution towards the total revenue generating by the organization is called as the contribution margin. That one unit's impact on the sales of a product is called as a contribution margin, so that they can easily identify. So if the fixed cost increases, again, what should be the target level of the sales, so that they can easily find out the break-even point analysis. That's why in the calculation of the break-even point, the importance is not only in identifying the fixed cost, variable costs, and the revenue. It is also important to calculate the contribution margin of that particular one unit of the products, and that is going to be calculating with the help of net sales minus total variable expenses of the product. That is the important components involved in the calculation of break-even analysis. So the next concept is when to use this break-even analysis, which means the producer, where he is getting the importance of the break-even analysis and how he is applying for the business. The first stage of the implementation of break-even analysis is to start a business. A business has to start. First of all, a producer will estimate what is the demand for the product and how much of expenditure he will incur on the product. Let us say to start the business, for the land, if he is spending 10 lakhs rupees, and for the machineries he has to spend 2 lakhs rupees, and for the material he is spending 1 lakh rupees, and for the operations and everything he is going to be spent 2.5 lakh rupees. So 10 to 12, 13, 14, 15.5 lakhs of rupees he is going to be investing on a particular product there. So for this 15.5 lakhs of the rupees, each unit selling price of the particular product is 100 rupees, and they can produce per day they can produce the products of a maximum 1000 number of units. So which means 1000 into 100, the maximum scope for the generating of the profits is 10,000 rupees. If he has to get this 15.5 lakhs of rupees, the number of days what he will takes. The number of days. So per day 10,000 means per month 30 into 10,000, that is 3 lakhs rupees. So for the 6 months or 5 months, 5.5 months, it will take 15 or 16 lakhs of amount, 16.5 lakhs of rupees of amount he will generate. So as a producer, if he has this analysis, this is all based on the break-even analysis. As a producer, if he has this analysis and he has thought that within 5.5 months or the maximum 6 months of time should be taken for the business at least to get back his investment. Afterwards, if that product is going to be yielding or the demand for that product is going to be for only 4 months, he can estimate up to what level of the benefit he can gain. Suppose that product type is the fade outs in the market, and the taste and preferences might be changes within 3 months. Then definitely the manager will take the decision of not to start that particular kind of the products or to start that particular new business. So before going to start that business, as based on the break-even analysis, he will analyze the chances of successfulness in the business. That's the importance of break-even analysis to start a business. The same kind of the analysis regarding the business, if they are applicable to a particular unit of the production, that is to create a new product, that is also called as break-even analysis applicability to create a new product. That is, and even if they want to change the model of the business, They have to have the knowledge of break-even analysis and to determining the remaining or unused capacity of the company. Once if the break-even analysis is reached, and how to restart that, can they restart that particular unit or not, and to estimate the maximum profit levels of a particular product or service providing by the business, and to to analyze the impact level of the profits on the revenue generating by the organization, as well as to estimate the losses that they could satisfy up to a sales reductional point of views. Everything, for all these situations, there is a requirement of this break-even analysis, and based on this break-even analysis only, the manager will take the best decisions. So that is the importance of the break-even analysis for the various stages, like fixing of a price, whether it is a price skimming or the price penetration, whatever the kind of the price it is. Before going to give a value to the particular product, it is better to know how much of expenditures they have incurred on the product and what is the break-even point, and to reach to that break-even point, how much time it will take with the existing price. If the target, the existence of the product in the short run is very less, means the price has to increase to get the maximum profits beyond this break-even analysis, because they should know the maximum saturation level. Then only they can set the goals beyond that saturation level. That saturation level analysis is the break-even point. So to take the better decisions regarding the expenditures and the revenues and sales targets fixations, the break-even analysis is more important one, as well as to figure out the missing expenses. So whatever the expenses, if they have lost or they have gained, they have incurred, then that can be identified with the help of this break-even analysis. For example, the organization has taken into the consideration of the machinery cost, labor cost, material cost into the consideration. They forgot that even though that is the owner's go down is there, that rent has not taken into consideration. They have sold that particular product and they have, unless they got maximum profits, but they missed that expenditure which is incurred. They have forgotten in estimating of that one, that can easily identify with the break-even analysis, because actually spending is more, but the break-even analysis is at less target levels. Then they can identify the missing expenditures which they failed to include in the production cost, as well as to plan the business funding elements, whether they can go for the investment or not, or they can start the new venture or not, they can take the new product into the consideration or not. This is also can be easily take the decision based on this break-even analysis, and to set the target levels for the revenue generation or for the sales. This break-even analysis is most important one for the producer, and to meet the fixed expenses, how many number of units that the producer has to sell can easily identify with the help of this break-even analysis. So that is the importance of the break-even analysis. The next concept is break-even analysis assumption. To execute the elements that as per the break-even analysis, certain level of the things should be constant. What kind of the elements should be constant, what should not be changed for the phenomena existing of the break-even analysis is termed as the assumptions of the break-even analysis. Here, the total cost may be classified into fixed and variable costs only. Any expenditure incurring by the producer either should be a fixed or variable. The semi-variable or the any other type of the things is not including here, which means the cost which is incurring by the producer should be identified either fixed or variable. The other elements are not taking into the consideration. That is the first assumption of the break-even analysis. As well as the cost and revenue functions remain linear, which means the expenditure which is incurring on the product and the revenue incurring on the product should be for single production at a single phenomena, single stage or time period of the time period in the particular market, and the price of the product is assumed to be constant because they are certain level of the price they have fixed what should be the number of products they have to sell for the break-even analysis. If the price changes, if the price increases or the reduce price increases before to the break-even point analysis, they will get their income back. Or if the price reduces, even at the break-even point, they won't get that particular revenue because of the price reduction. They may get the they may have to sell more number of the units than the previous price. So which means the price should also be constant if the planned break-even has to achieve. The next thing is the volume of sales and volume of productions are all equal. That's the most important points to note is if the producer has produced 100 number of units and it is assuming that it is going to be selling the 100 number of units, so that it is not taking the wastages into the consideration, damages into the consideration, because they are all assuming that the number of products which is quantity which is produced is going to be selling. And if any damages will occur, and again the break-even analysis may be changes. And the fixed cost remained constant over the volume under consideration. Again, it is also things that if micro factors of fixed cost remains constant up to certain time period. If it is changes, again the analysis will also be changes. And also it is assumes that constant rate of increasing in the variable cost, which means if one product unit price is 10 rupees, then the 2 units price is 20 rupees only, it assumes. For the 2 units, if it become 18 rupees, again the break-even analysis will be changes because the cost again changes. That's why it assumes that the increasing rate of the variable cost is again constant, and it is also assumes that the factor price remains unaltered. So that is the price changes which is between two intervals which is estimated by the producer remains constant. There should not be any changes in the price levels at two intervals, and changing in the input price are ruled out. So there is no changes in the inputs, that is substitutes. Same level of the inputs they have to use, same cost, fixed cost, and same level of the variable cost they have to incur on that particular product. And that is in that cases only the break-even analysis estimation will holds good. Otherwise, if any changes occurs, again the break-even analysis will be changes. And it is not most preferable for in the case of multi-products form. That is, product mixes changes from one period to another period. So this time they will produce one kind of the products. The next time if they are producing another kind of the products and it is changing, this break-even analysis may not be holds good for that one. Which means the product mix of that company or the industry should also be stable. That in this, if all these cases exist or holds good in the market, then only the break-even analysis calculation will be holds good. If any of these factors changes, again the break-even point calculation will also be changes. That is the assumptions of break-even analysis. So because of these assumptions, we can say certain things might be possible in the real market or certain may not be possible. That uncertainties in the assumptions of the break-even is termed as break-even limitation. That is, assumption of sales price at constant level of the output may not be realistically exist. That is one of the limitations for the break-even analysis. And assumption of production and sales are same. So obviously there must be a damages. There might be some wastages are all occurs in every productional level to the sales. That is ignoring in this break-even analysis. That is one more limitations for the break-even analysis. And break-even charts may be time consumptions to prepare based on the single product or single product mix. So time consumption, anyhow it will take some certain time for the analysis of that one. So these are all the assumptions for the limitations for the break-even analysis. So though it has the limitations, but it has its significance in determining the best decisions by the producer. So that's way to determine the break-even analysis, two elements are all taking into the considerations. That is the level of the output level estimations, either can calculates in terms of the physical units or in terms of the sales units. That is called as the determination of the break-even units. Simple thing. If a producer has to sell 10,000 number of units to get back his investment back, means the break-even analysis is explaining in terms of number of units or the physical units. Or if it is not possible, then if the producer sales are sales revenue, that is amount, number of amount, if he sells for 10 lakhs rupees of the amount, then he will get a maximum, he will get no profit, no gain, means again here the profit is the profit levels of the zero is estimating in terms of the sales revenue. That point is called as break-even point in terms of sales revenue. So BEP, that is break-even point, can estimates or can determines in two ways, either in terms of the units or in the terms of the sales revenue. Then apart from the break-even revenue, break-even point, the remaining benefits gained by the producer will be called as margin of safety. Margin of safety. So for example, if a producer is selling the each unit price of 10 rupees and he has sold 500 number of units, 500 number of the units, and he is gaining 5,000 rupees of the revenue, out of which, so revenue, out of which each unit price is cost expenditure for the product is 8 rupees, including of both fixed cost as well as variable cost. Then 500 units means 4,500 rupees of the cost which is they have incurred on that particular product. So the break-even point is 4 lakhs. Break-even point is 4 lakhs 4,500. 4,500, and the total revenue generated by the organization is 5,000. So the difference between the 4,500 to 5,000 is 500 rupees, which is called as the margin of safety. Margin of safety. And this is 4,500 is in terms of the amount which they are representing. That is called as the break-even point in terms of the sales. Then, if they have sold 450 units, if they will get, assumes that they'll get this point, instead of 500 units up to 450 units, they'll get this 4,500 rupees of the amount, means then that is units, in terms of the units they are all representing. That is called as break-even point in terms of the units. They have sold, actual sales is 500 units, break-even sales is 450 units, means the margin of safety is in terms of 50 units. Additionally, they have sold that 50 units or the 500 rupees is called as the margin of safety. That is the determination of the break-even point, either in terms of the physical units or in terms of the sales revenue, and more the actual revenue minus break-even sales will be called as the margin of safety. So, with this break-even analysis, in the real practices, the significance of the break-even analysis will be useful at different stages. One is to calculate the safety margin with the formula of sales minus break-even point divided by sales into 100. We can calculate the safety margin. So, let us say 100 units is the BEP. Up to 150 units the sales has done, then 50 units of the safety margin, that is on the total sales it is 1/3, that is 33.33% of the margin of safety can be calculated if they have the analysis of the break-even point. And also by using this break-even point we can calculate the level of the output for the target profits, but with the formula of target sales volume is equals to fixed cost plus target profit divided by contribution margin per unit. So what is the fixed, let us say 10,000 rupees is the fixed cost by the organization and they are expecting a profit of 20,000 rupees. Then each unit is contributing 10 rupees, means contribution margin means the unit price of the product is 8 rupees and 28 rupees is the price of that 18 rupees is the price of that product, means 10 rupees is the contribution margin of that particular product. So that is equivalence to 30,000 divided by 10. So 3,000 number of units if they will sell, then there is a chance of getting 20,000 rupees of profits, which means to calculate this target profit, this break-even analysis is useful, and the changes in the prices and its impact on the sales volume can also be calculated with the help of this break-even analysis by using the formula of total fixed cost plus total profit divided by new selling price minus average variable cost. And also, if any expenditure levels changes, that impact also can calculate with the help of this break-even point by applying the formula of new quantity or sales volume is equals to contribution to margin divided by present selling price minus new variable cost per unit. That can also be easily calculated, and to take a decision of technical substitutions in the production can also be used with the analysis of the break-even analysis, and to make or buy, that's a very important one. If the product's making is below the break-even point, that is they are getting the losses, not even getting the expenditures back, so that they can stop that production. Then if they have the analysis of more than the BEP, then they can buy that particular unit or they can start that particular business. So make or buy decisions can easily take with the help of this break-even analysis. Not only this, break-even point that is based on this fixed cost, purchasing price and variable cost, and the impact of the purchasing price can also be calculated with the analysis of the break-even, and plant expansion decisions can also be taken by taking the present capacity levels and expansion capacity levels comparison with the help of this break-even point, and to take the decision of whether to continue that plant or shut down that plant, and to take the decision of increasing the level of the production or to increase the promotional mix or the product mix of that particular product, and decisions regarding the addition or the deletion of the product lines or additional products to that one, and the decisions regarding the addition or deletion of the product mix can also be take the analysis of the break-even analysis. And this is the significance of the break-even analysis, and what is the break-even analysis and importance for the producer based on the cost analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.